Everybody, it's Mark Johnson with Guaranteed Rate. And today I want to share with you some financing tips that we need to educate our borrowers about. So, when Congress passed the debt ceiling bill, they also had a clause in there that student loan repayments would start 30 days after it was passed. So, we're figuring September 1st is when borrowers who have student loans that have been deferred for the last almost 4 years are going to have to start making those payments again. And a lot of borrowers are not calculating that in their monthly payments because it's been deferred for so long, and they may not know it's starting in September. Or if they do, they may not know how much it's going to be. It might create fear. They might say, well, I want to hold off for another year and see how the dust settles. But I've put together kind of a chart here, a total cost analysis that will show them that they can go ahead and buy now with confidence, and it'll still fit in their monthly budget. So let me just share my screen with you here. You'll notice that in this total cost analysis, our purchase price is going to be right around. Well, I just put $600,000 to be a starting point, and then their loan amount is going to be $589,132. Today's interest rate on an FHA loan is approximately 6.75. Their mortgage payment is going to be right around $4,500. Out of pocket's about $29,000. And their monthly savings right now is $750 because they're not currently making those student loan payments. Now, come September 1st, you're going to notice that their interest rate's still the same, but their overall budget's got to include that $750. So that's like making a payment now of $5,274. In other words, their payments are going to go up $750, right? So how can we help them do that in a way that their payments aren't going to go up and that it'll fit into their monthly budgets? Well, my favorite way to do it, because I think interest rates are going to come down in the next year, is to do what's called a 2-1 buy down. So 2-1 buy down basically starts you out at 4 3/4 for the first year. And then on the second year, you're going to be at 5 3/4. And then the third year, you'll be back at the note rate. Right. So the monthly payments you'll notice here is right about almost exactly the same on a 2-1 buy down as if they had a $750 payment. They're going to still, be able to make their monthly payments because that's what they're qualifying for. Now, another way, an option 2 would be to do what's called a permanent buy down. Now, a permanent buy down is where we pay extra discount points, obviously, to lower the interest rate. And we ask the seller to pay that small amount as far as and make that seller concession. So in today's market, it's getting harder and harder to negotiate that. But let's just say that it's going to be right around 3%. They're used to paying 3% in closing costs. So that gives them a rate of about 5.625. Now, that gives them the security that that monthly payment, even though it's going to be right around $429 or $320 more than what they're planning on paying at $4,500, they're going to be able to have that payment for the whole 30 years. And so if they're thinking that maybe rates won't come down and they won't have an opportunity and they want that security, then option 3 might be the best way for them to go. Anyway, I hope these are some good thoughts for you to think about and to explain to your borrowers some of the options that they may have, even when student loans start being required to be paid back. If you have any questions, please don't hesitate to give me a call. If you like this presentation, like and share it on Facebook and YouTube and LinkedIn. I'll put some slides in Instagram as well so that you can have these to show to your borrowers. All right. Have a great day and a great week. Thanks. Bye.